Good morning. It's Friday. Welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Rajat Jain. You're watching Indian Open. The fact that I mentioned it's Friday before anything else lets you know how important I think this Friday is. Anyways, before we get to that, let's get straight to the headlines. The European Central Bank is set to halt bond purchases in December. Mario Draghi says the euro economy is strong enough to overcome risks. Donald Trump is set to decide to impose tariffs on Chinese imports worth $50 billion with a focus on tech goods. Vakrangi changes its capital allocation policy, says will first spend on ATM capex before deciding on the proposed buyback. Host Russia kicks off its World Cup campaign in style, beats Saudi Arabia 5-0. And that was some match. If you were a host nation and if you were one of the host nation members and present at the stadium, boy, you would have been for a joyride for sure. Okay, let's focus on the trade for the day. What's happened overnight? ECB, the big decision. The ECB has decided to end the QE stimulus program from December. Mario Draghi says that the economy can beat any kind of risks that may come up. As a result of this, from now on until some event happens, the opinion will remain divided on the impact of the global retreat in liquidity, with both the Fed and the ECB now seemingly on the same path. What this does in maybe 2019, maybe mid-2020, you don't know when it will happen, if it will happen, but you will consistently see divided opinion coming in on the impact of the retreat of liquidity by the large global central banks. So, yeah, let's see. It'll be very, very interesting. Hopefully, it doesn't result in a sudden fall due to liquidity retreat in any of the major asset classes. The trade setup for the day, just look at what happened in trade yesterday. After a fairly decent run the last few days, the major indices, at least the Nifty and the Sensex, did snap the 3-day winning streak. The cash market volumes continue to remain very, very thin, and the market breadth too remained weak. But the good part was that towards the close, the market breadth did improve quite significantly. We still ended in favor of the declines, but it almost nullified the gains the declines had for most part of the trading day. And if you look at the sectoral indices, save for Nifty pharma, almost every other index was down in the green, but pharma did extremely well for itself. So up 1.8% on a day when almost everything else was down in the dumps shows you the kind of gains that the pharma index showed in trade yesterday. So what do we do in the session today? If you just look at what the European or the US markets did in trade yesterday or what the rest of the world is doing today, it will suggest it's a bit of a mixed bag with a flattish start. The US markets are up and about, by the way, at 7:38 p.m. Post that came off, though the Nasdaq was up about 1%. The Asian markets have started off on a mixed note. The SGX Nifty indicating a bit of hint of a pullback, but this could be deceptive as well. I would presume a flat start is what we can expect in the session today, and then we take on from there. So if the start is going to be flat, what are the key stocks that one should monitor? That's the big thing, right? So there are 3 or 4 that I thought we should highlight right now and then take it up a bit later on. Firstly, the pharma names. Start off with Dr. Reddy's. They've approved the first generic versions of Suboxone. And I think if I just read Darshan's tweet, which he's just put out in a few minutes ago, they are going to be doing it an on-risk launch, which means that there is significant upside if there is no litigation, and they will take on that risk of that litigation. But if they lose any kind of litigation, then the downsides could be substantial as well. But Dr. Reddy's is confident of going ahead with an on-risk launch. So let's wait and watch what happens to this stock in the morning. Well, in all likelihood should be good, but the stocks have rallied quite a bit, right, from YTD lows. Look at Sun Pharma, Lupin, Aurobindo Pharma. All of these stocks have gone up substantially. Let's wait and watch how much further steam is left in the pharma pack and Dr. Reddy's individually in the session today. TCS, and we'll talk about it on First Word in detail. They're going to consider buybacks. Therefore, TCS remains in focus throughout the trading day today. Yesterday was a particularly poor day for IT. 25 years of Infosys, but TCS, Infosys, Tech Mahindra, everything came off. Let's wait and watch what happens to these stocks today. Vakrangi is a stock in focus. Now, for more reasons than one, and we'll do a detailed analysis of what the announcement of Vakrangi means. But if earlier the belief was that they'll spend all the money that they have on a buyback, now they're coming out and saying that the decision on buyback will be taken later on. Right now they're going to spend the money on some expansion plans, etc., business development, loosely put. That brings into question mark, even though they have not said it explicitly, as to whether or not a buyback will go ahead in the first place or no. I repeat, no explicit mention, but there are enough hints to suggest that maybe, just maybe, the buyback may not happen, and this might just put a spanner in the wheels. Really, it's a company that has befuddled many. The stock, which keeps on rising or going down on any single day at the drop of a hat at its own whims. I doubt really that this will be taken to positively by the markets, but I reserve the right to be wrong. Let's wait and watch what happens when the markets start off. And amongst a clutch of brokerage names, I've chosen this one for a reason. RBL Bank, since the last 2 days, is finding a lot of favor on the charts from technical experts. Investec has come out with a note. They're maintaining a target of 660. It's not just about the brokerage house and the target thereof, but the rationale that they're giving. It's talking about how partnerships will be a source of high profitability, and visibility on the ROE improvement is high on a 2-year time frame, which is very, very important from a bank's perspective. They believe the profit may grow at a 40% CAGR on better return ratios. So fundamentally, a lot of ticks that people believe, and Investec believes RBL can show. A lot of technical analysts like it on the charts as well, which is why I thought it's important to highlight today as amongst the companies that could react in the morning as well. However, let's take stock of what's lined up on First Word. It's a collection of the top editorial stories that we want to bring to you, starting off on Indian Open. First Word, as N. Chandrasekaran gets ready to address his second TCS AGM as chairman of Tata Sons, shareholders will look out for announcements on the proposed share buyback. Indian steel makers are slowly but surely making their way out of the woods, and they have China to thank for that. DMart's management was candid enough to say that it is wishful thinking to expect same-store sales growth to stay at 20% in the first ever analyst meet. And as the last piece, private insurers don't seem to be able to keep up pace with LIC, at least in the month of May. LIC still continues to hold on to more than 50% of the total life insurance market in India. We'll throw some light on what the data came out in May and how does that augur for the listed private life insurers. However, the first up and the most important one, it's a D-Day, or the day that TCS shareholders have been waiting for. The country's largest technology company will consider a buyback of shares at its annual general meeting today. The stock has already run up, maybe in anticipation of the reward, maybe otherwise, but Agam Vakil Johnson with the big decision and the commentary that is to be eyed today, and the balance sheet that can support this. I'm sure the balance sheet can, but Agam, what should people watch out for?
So we know that TCS has about 40,000 crores on the balance sheet. That's in current investments as well as cash. We're expecting them to deploy some of it. We already know that they are going to consider a buyback. So based on the 25% calculation on the net worth, that comes to roughly 21,000 crores. And that is the sum that can be availed for using the buyback. Though a lot of reports out there are suggesting that the buyback could be up to as much as 10,000 crores. Again, we're going to have to wait and watch, Neeraj, because last time around they had already carried a buyback worth 16,000 crores. So 10,000 looks slightly small to me, considering they have an arsenal at their disposal. That said, they've already given out a bonus of 1:1. Last time around, they gave a buyback of 16,000 crores plus special dividends worth well over 11,000 crores. So we're going to have to watch out for what the dividend policy is as well. And these are some of those areas which is going to be critical for a lot of shareholders, and we're going to keep an eye on that when it comes to capital allocation.
The interesting part, Agam, is that quite unlike the last time that the buybacks got announced when the prices were low and people believed that the buybacks were a means of shoring up the share prices. Now the prices, in that interim period between the last buyback and now, have rallied significantly due to fundamental reasons. So there's a bit of a difference to this buyback announcements compared to the last one.
Yes, absolutely. So if you consider the buyback carried out around 28.50, if I'm not mistaken, and a post-bonus adjustment around 1,425. Even after that, the share price currently stands around 1,780 odd. Last time it was at 16% premium to the day on which the buyback was carried out. If I consider a back-of-the-envelope calculation of around 15%, that means the buyback should be somewhere above the mark of 2,050 per share. So it will be significant if they do carry it out around at around that premium, and we're going to watch out for that. But of course, it's not only going to be about capital allocation. There are several other things, but a lot of these things have been spoken about. Their business 4.0 strategy, what they're going to do, the fact that the demarcation between traditional services and their digital services is now disappearing slowly and steadily. The company has suggested, and investors are convinced that they are positioning themselves very well as the next generation service provider, and what they have in mind are some of those other factors you're going to watch out for.
Interesting. Let's wait and watch. For years, the customer-centric focus, lots of people at the bench to help out those customers. The last decade, the last 8 years, they've certainly been paying off for TCS.
Yes.
Let's wait and watch what happens here. Right. The valuations will be interesting if they indeed announce that buyback. At what price and what PE multiples are they willing to buy back those shares as well? Yes. Agam, thanks for putting that into perspective. It's going to be a busy maybe afternoon for Agam Vakil for sure, as for the rest of us, but Agam for sure. Thanks for putting that into perspective, Agam. Okay, that's as far as TCS goes, the first story on First Word. The second one, Indian steelmakers have come a long way since the time the government was forced to introduce the minimum support price on steel imports in February 2016. A lot has changed since then, most significantly, a crackdown on Chinese steel production, thereby taking global prices higher. It has also prompted analysts to raise their expectations from Indian steel companies. Nikki Mirchandani is here to take us through all the factors that are fueling this optimism. Nikki, good morning. It's evident in the share prices, but tell us the fundamental factors.
Sure, I'm going to start off actually with the numbers just to prove my point later on. If you're supposed to look at the growth estimate that Bloomberg has projected for all the for the steel companies, Tata Steel, JSW Steel, SAIL and JSPL, I'm going to start off with the revenue where they're expecting for FY19 a growth of 7, 10, 19 and 31%. 31% being that for JSPL, that's the highest that we have in terms of revenue. In terms of EBITDA, we're looking at a good 13 to 28% kind of a growth for the top two steel producers, JSW and Tata. And for SAIL, we're looking at a number which is more than 100% and 45% for JSPL. Let's look at earning per share. The growth that we're looking at from FY18 to FY19, it's a 52% for Tata and JSW Steel. And we're looking at a profit of maybe a positive EPS for both these companies after 12 quarters or after 3 years. What explains this dynamics is clearly the production and also the kind of demand that we're witnessing right now. If you look at this graph, you'll understand the first thing that we can actually pinpoint is the steel prices, which are currently trading at a multi-month high. If you look at the TMT prices and the HRC prices, they're at a good 56,480 and 50,125 per ton level, which means that TMT and HRC both have risen for a good 25 and 32% on year-on-year basis. And if you look on YTD basis, we're looking at a growth of roughly 8 and 16%. What explains this kind of soaring multi-year steel prices is definitely the demand that we're witnessing. If you look at the demand picture that we've put out, you would see that if you look at the 2-year CAGR for demand, which currently stands at 4%, this is in line with the average that we've seen the previous year. What explains this growing demand? Well, the momentum is coming in both from the government side as well as the consumer side. Let's look at the second factor, the third factor in fact, the imports that have been rising. The country actually has turned net importer after a span of good 22 months. What explains this? We're looking at a number of 41 million tons as in terms of 1,000 tons in terms of the imports. What explains this? Also, it comes after exports. Now, exports have been declining month on month. If you look at the number that we've seen in May, exports have fallen by a good 30%. They've fallen as much as 19% in the month of April. So what explains the falling exports? We have two things to it. A, you have a strong demand, domestic demand, and B, also most of these players are running at their complete capacity utilization levels of the existing produced. Also, last point that we'd like to highlight is the reason behind the trade gap. Now, one would want to understand that despite why is the country turning importer even as the exports are falling? Well, Morgan Stanley explains this quite clearly. It says that the domestic demand has prompted steel makers to cut down exports and actually resort to more import measures.
Well, Interesting. Nikki, thanks for putting that into perspective. So that's as far as the metal space goes, and why is it that steel companies at least are bearing some benefits, and in part thanks to China as well, as our headline stated. Okay. Third piece, I'm borrowing some knowledge from brokerage notes that have come out yesterday and some data from the IRDA website as well on life insurers. Now, the last few days, life insurance companies have been under pressure. It's still dominated by the state-owned player, LIC of India. Maybe that's the reason. In fact, LIC is gaining market share even as more and more private players crop up. Now, let's first look at the small impact on stock prices that have happened, in part due to the higher run-up that we've seen in these companies, and maybe in part due to some bit of cooling off in the kind of growth trajectory. Whether or not it lasts or no, we'll weigh in on that a bit. But look at this. HDFC Life is down about 11% from its recent highs. ICICI Pru about 11.5%. SBI Life about 10%. So all of the large players, which are standalone life insurance players, have all come off. I've excluded Bajaj Finserv here because it also derives a part of its valuation from Bajaj Finance, and therefore it would be unfair to put Bajaj Finserv in the same bracket out here. What's happened in the month of May? Private players grew a mere 4% on a low base. LIC over 20% on a YOY basis. The market share of the private players declined to 47.5% in the month of May, which is a market share dip of 600 basis points month on month. LIC reportedly about 11.8% growth that came in for LIC on the weighted received premium basis. So LIC reported growth, private players' growth declined, their market share declined, and on a month-on-month basis, it was a 600 basis point dip. I've borrowed a chart from the Motilal Oswal report, if we can bring that up, and that shows you the share between the private players and LIC over the years. If you just see from FY10 onwards till FY13 or FY14, yes, LIC dominated. The last 4 or 5 years, almost every single year, the share of the private players has gone up and that of LIC has declined. There has been a bit of a turnaround of sorts in FY19 YTD. It's too early to say. Maybe this will change. And even if the growth numbers for the private players stay good, if LIC continues to grow the way it is, LIC is giving the private players a good fight. That is the key thing. It was believed that private players will completely swamp over everybody else. That hasn't been visible in the month of May and FY19 YTD. Now let me draw it down to each of the three ones individually, what happened in the month of May and what are the maybe a couple of technical factors as well. So in the case of ICICI Pru, the bank's decision to sell about 2% stake was probably a technical factor. They have announced that they might actually sell some more as well. So that's a bit of a technical factor. The individual annualized premium equivalent dipped over 30% on a high base, which was in line with April as well. So in June, the APE dipped 30%. This was in line with what happened, or rather in May, it dipped about 30%. This was in line with what happened in April as well. Most people believe, though, that because of a low base last year, the growth rate for ICICI Prudential will improve in the month of June. But ICICI Pru was that big drag for the private insurance in the month of May. HDFC Life too, the growth softened to about 11% YOY in May after an extremely strong move in the month of April. However, the good part for HDFC Life is that the growth, whichever growth that came in, was supported by higher volumes given the dip in ticket size, and that's a better way to grow as opposed to having a higher ticket size but lower volumes. SBI Life was actually a standout amongst these companies. The individual annualized premium equivalent grew northwards of 27%. 4 months of very soft growth in the calendar year thus far. But the month of May was very strong for SBI Life, so that showed up some bit of performance for these players. Otherwise, LIC was all over them really in the month of May. So is it all bad news? Well, maybe not. There are some silver linings for the private insurers, even though there are some clouds in the month of May, the prices have come off, but the silver linings. The market share of the top 5 private players within the private player space is at 65%. So there is a bit of a polarization that we're seeing in the private insurance space, where in the top 5 players, which is these 3, Bajaj Finserv included out there, are all just gaining market share at the cost of some of the smaller and fringe players. Within these, of course, the last month, HDFC Life and Bajaj Allianz have gained maximum market share, at least not just in the month of May, but in FY19 YTD. This is, of course, as per the Motilal Oswal report. And as I said, save for HDFC Life and for private sector, by and large, the growth was driven by volume rather than just a higher ticket size. This implies that there is a tilt towards higher margin protection products. Almost all the life insurers are saying that they are now trying to move towards the pure protection plays, which is the term insurance plan, as opposed to life insurance that has got higher margins as well. And the volumes that are coming in show that there is a tilt towards those higher margin protection plans, which might only augur well for these companies. Let's see, the month of May wasn't the best. If indeed June can reverse some of the fortunes for some of the life insurance players. I'm not talking about the stock prices, I'm purely talking about the business. What happens to the stocks is anybody's guess, really. Okay, so that's as far as life insurance goes. Lastly, the stock that everybody talks about almost every single week, Avenue Supermarts, is the fastest to hit the 1 lakh crore market cap. And of course, they run the DMart chain for the people who don't know about this, but it's run up about 144% since listing just over a year ago. Actually, maybe slightly more than that. And the company also held its first analyst meet yesterday, where they were candid enough to accept that it's unrealistic to expect the same store sales growth to continue at 20%. Yatin Mota is standing by with a snapshot of the profile, the opportunities and challenges, and what stood out for him out of that analyst meet. Yatin, good morning.
Good morning, Neeraj. And as you can see from the chart, the stock from the listing market cap of close to 40,000 crores is now a little over 1 lakh crore, or around that 1 lakh crore mark in terms of market capitalization. And money must be wondering, there has not been much of a change in the last 1 year. The stock, is at a 1 lakh crore market cap. What now from here? But let me take you through what the company has already done so far. And of course, it's an achievement in itself. They have best in the class margins, best in the class operating performance, and best in the class locations for their stores. Current store count is 155 stores. They almost have 5 million square feet area, which has been covered by these 155 stores. And they do almost 30,700 crores worth of sales per square feet. So that is the kind of synergetic and high growth that the company had seen in the past. If you look at the breakup, more or less the large presence is here in West India. So you could see Gujarat with 30 stores, Maharashtra with 62 stores. Of course, they're headquartered here, so bulk of the concentration is here. And Karnataka, Andhra Pradesh forming another 22 stores together. Of course, we also have Telangana, which is an important part of their strategy, almost 20 stores there. So these are the few select states wherein the company's presence is almost concentrated. And if you look at the pie chart for the revenue share, what business does DMart do? Nearly 50% of their sales come in from the foods business. Almost another 20% comes in from the non-food business. And here, which is probably the margin gainer for DMart, 28% of their sales come in from the apparel business. Clearly, if you look at food and apparel, nearly 80% of the sales come in there. We have the non-food item, which includes a lot of, the cutleries, kitchenware products. Those are the products typically falling in the non-food category, utility items. That is almost 20% of their overall revenue pie. So this is what, DMart has been doing and has been looking at for the last many quarters or so. Now let's talk about the opportunities which the management highlighted in yesterday's analyst meet, and this is quite important, that they are looking to add 50 to 60 stores in the next 2 to 3 years. This is not a very aggressive target, because currently they are at 155 stores, and if they add 55-60 stores, they will be 35% higher from the current level in the next 3 years. So the management clearly said that in terms of store addition, they will be very selective, they will be very choosy, and they will not rapidly keep on adding stores. As and when the opportunity comes, they will be looking at it, and most of it would be funded by internal accrual. So as of now, they do not need any capital to add these many stores in the next 2 to 3 years, more importantly. And e-commerce, that is one bit which is not a part of their sales strategy. Currently, they are not focusing on e-commerce. They are more focused on the brick and mortar model. Of course, that is one segment which is yet to gather steam. So, this is probably one sector or one segment wherein they can, look at some growth moving forward. Let's talk about the challenges. The opportunities are few, but the challenges are quite high. Management yesterday clearly said that the margins may peak at the current level. So from here on, probably they are looking at margins which will be capped. Remember, they have store addition going on, so that will be a pressure point, because they have initial opening cost, setup costs to be borne with. So margins would be peaking at current level is what the management feels. they say that the growth for mature stores or older stores will be capped at 10%, and it is very difficult for the current stores to grow rapidly, is what the management appraised analyst to about. And the same store sales growth is something which can stagnate moving forward, is what the management made it clear in the analyst meet, because they are not chasing aggressive growth. They will be focusing on the product mix, they will be focusing on the margins and how to maintain the current margins. So they asked analysts that, probably don't be surprised if we do not show stronger growth, stronger double-digit growth. And finally, they will be venturing into the franchise model. We don't know how successful they may be, because currently most of the stores that they operate are owned, and they overall run their stores by themselves. And how the franchising model takes place moving forward, that is something we'll be watching out for.
Okay, thanks a lot for that, Yatin. So that's Avenue Supermarts, and the management rightly cooling off some of the massive expectations that the street may have had. Yatin's dissection of what they had to say in the analyst meet, as well as what could be the way ahead for Avenue Supermarts. That's all that we have on First Word today, but lots more lined up on the show as well. Discuss markets and macros with Rajat Jain of Principal Mutual Fund. As the Indian hotel industry catches the cusp of an upcycle, is bike hospitality ready to cater to the rising number of voyaging Indians? We asked the Vice President Mihir Sarkar about what makes Ventura so bullish on their company, and then discuss the growth prospects for Cyient with President and Chief Financial Officer Ajay Agarwal.
Welcome back. You're watching Indian Open with us on Bloomberg Quint. Let's tell you what the Asian markets are doing right now. Well, it seems like a mixed start for the Asian market this Friday, though some bit of recovery has been seen for Nikkei, which was down over 200 points in the previous session. That's seen an uptick of nearly 90 points. Remember, the monetary policy comes out today from Japan, so watch out for that. Shanghai is down by 10 points, and SGX Nifty right now indicating a start below the 10,800. Remember, the markets were also weak in yesterday's session. Let's check with Agam Vakil then what sort of cues we are getting from the derivatives market. Hi Agam, good morning.
Good morning, Navneet. Well, again, when you consider the way futures and options space is panned out, let's start off with the futures. On the Nifty, at least, you're looking at some amount of unwinding, considering 3% decline in open interest, even as the index also declines by as much as 0.5%. So longs unwinding coming through, and it's coming down to the Nifty bank futures. It is the same, largely, with the index coming down by as much as 0.3%, and some unwinding coming along as far as the OI goes too. The WIX, of course, well, we have seen that move to a certain extent, but largely within the range. In terms of changes in open interest, as you can see here, we're starting to see a little more writing now when it comes to the 10,800, 900, and the 11,000 calls. And this is curious, because until yesterday, we had that writing coming through at the higher levels. We also seen a lot of unwinding inputs, considering yesterday's day of trade was and did see some weakness. That aside, moving across in terms of the way we've seen maximum open interest pan out, it continues to be at around the 11,000 call, but on the lower end, it's starting to shift from around 10,400, 600, and now it is at around 10,700. This gives you an indication, or at least in the near term, it's going to be a 300-point range. In fact, a lot are suggesting a 200-point range between 10,700 and 10,900. In terms of some other changes, we have Balrampur Chini and Diwan Housing, which moves into the F&O ban, and we also have Jet Airways and of course Just Dial, which are also in the ban. And in terms of the put call ratio, as you can see here, it's come off to a certain extent at around 1.55. That's on the Nifty. The Nifty bank put call ratio also coming off to around 0.95. So moving back below the mark of 1. In terms of some stocks, ICICI Prudential continues to show weakness. We see a surge of open interest yet again. So it continues to show that decline, of course, even as its parent considers paring stake in this particular company. And in terms of some other stocks, we have Aurobindo Pharma, which moved up as much as 4.2%. Open interest, very little change there, but there has been some amount of short covering, considering we've seen the strength in a lot of these pharma companies. And SRF, finally, we've seen that stock move up as much as 2.3%, and short covering seen there as well, considering so much volatility coming through for SRF. So these are some of the stocks that I'm going to watch out for, other than the benchmark indices, which for now are showing at least a subdued opening.
Well, thanks a lot for that, Agam. We'll watch out for these and talk to our experts about these as well. But start off the show, or start off this segment, with a fundamental Voice. T.S. Hariyar, founder and chief executive officer at HRBV Client Solutions, joins us right now on the show. Hari, good having you. Thanks so much for joining in. Yesterday was arguably one of the first days in many when IT as a pack showed a bit of a pullback. What a day to choose. 25 years of Infosys and almost all of those came off. We have the TCS buyback slated for as well today. Yeah. What would your thoughts be on large cap IT currently?
See, I think we were neutral till about some time back, considering the kind of a rally. But I think if you read the fine print of the Fed data, I think one thing is very clear that the US is now going to get back above the 3% GDP growth mark. Probably, not in this year, but probably 2019 is going to be 3.1 and about 3.4 in 2020. That is a kind of a guidance that the Fed has given. And if that happens, I think it is going to be accompanied by a lot of IT spending from US corporates. So I think for Indian IT, this is good news, and I think it is probably a reaction to that which we actually got to see yesterday. Of course, Infosys 25 years, I think, was probably one of the stories, but the essential, I think, story in favor of large caps appears to be the revival in IT spending in US, especially considering that the GDP is going to be higher now in the next 2 years.
Okay, interesting. What's the call on pharma? The stocks have done fabulously well. We're just doing the stats. 20-25% from the YTD lows is almost a given for the large cap pharma space. Are they kind of nearing a level from which there could be some technical pressures, if not fundamental?
Technical pressures, yes. I think apparently what has happened after the Sun Pharma Halol plant case, is that there seems to be a belief that the whole FDA thing may have been actually overblown. And I think that is what is probably showing. Now, see, if you look at stocks like Lupin, ultimately they continue to be good stocks. Probably there have been some lapses in their R&D, in their processes, but they continue to be solid stocks. And if you look at the price in the last 2 years, I think it's down about 70% or odd. So I think obviously, in my view, the worst is over. Technically, I agree. After 25% bounce, especially after almost, I would say 2 years of dryness, you have 25% bounce. So some technical pressure likely, but I think fundamentally, probably we made the bottom on pharma.
Well, we'll have to wait and watch for that. But the Nifty Pharma Index definitely remains the top sectoral gainer for the week. It's up nearly 6% for the week. But let's talk about individual stocks. Vakrangi came out with its fourth quarter earnings last evening. While the numbers weren't anything to write home about, with EBITDA margins seeing a sharp drop, what's got everyone's focus is the change in stance as far as capital allocation strategy of the company is concerned. So what's changed there? Let's ask Darshan Mehta. According to him, what exactly the capital allocation policy they've changed the stance at, Darshan?
Yeah, so basically what happened was earlier on 12th of Feb, they came out with a press release indicating that they plan to change, they plan to have some changes in the capital allocation policy. There is when they announced a buyback and a dividend. So 1,000 crore buyback was something that happened. So this was what happened in Feb 12. So they said that they will use 1,000 crores for buyback, 250 crores for dividend, and 122 crores will be reinvested in business. Sorry, this is 250 crores, not 2,500 crores of dividend. So 1,250 crores was the total amount that they needed it. Now what they're saying is that, they haven't explicitly said that, they are cancelling the buyback. First, they're saying is that they have a plan now to increase their ATM, visibility. So they have 45,000 kendras, and they say that, we will install an ATM in each of these ATMs, and each ATM will cost almost 2 lakh rupees. So that's almost 900 crores of capex that they have envisaged. So first they are saying is they will increase the ATM share. They will actually first take a look at the 5,000 kendras out of the 45,000 kendras in which they will install this ATM. Post that, they will take some bit of views on the capital allocation policy. So there is a change of stance. They haven't completely said that they are scrapping it, but that gives an indication if they have 1,400 crores of cash on the book and 900 crores will be spent on ATMs, and they plan to increase their share of kendras from 45,000 to 75,000 by 2020. That means another 500 crores of capex will come in. So that entire money will be used there. So whether any money will come to shareholders by way of dividend or buyback is anyone's to guess. The new strategy that they have said is that they will upgrade all the 45,000 outlets. All of them will have an ATM, and the long-term target is 75,000 outlets by 2020, and even then all of them will have an ATM. Now the ramp up will happen in the ATM business, and capex has been used. 2 lakh rupees per ATM is something that they are saying, and they are saying more than 2 lakhs. So we are assuming a 2 lakh, but more than 2 lakhs will be allocated per ATM. AGM as per them, and they are taking no mandate for the legacy business. So what they're doing is focusing purely on the Kendra business. They have taken a one-time hit on the legacy business, a 220 crore one-time provision that they've taken, or a write-off they have taken, because they don't expect the money to come in from that project. So that is their new strategy, what they've planned out. Fourth quarter was extremely weak for Vakrangi this time around. If you're looking at it, one-time write-off in e-governance business, 220 crores was the amount that was there. 219.95, 290 crores was the amount that was factored in as far as the PNL is concerned. And finally, if you're looking at it, the good thing that they've done is that, they've made the company debt-free. They've repaid all the debt. Revenues were up 60%. They've considered that a one-time expense as part of the EBITDA, as part of operational expenses, and that comes in the EBITDA, and that is why it was a 64% drop that came in. Even profit, it trickled down to the profit. But nevertheless, I think more than the financials and this one-time write-off, I think investors will be more disappointed with the change in stance that the company has given in terms of their capital allocation policy.
Thanks a lot, Darshan, for bringing all those details. Hari, what is your view on this one? I remember when the buyback news came in the month of February, that was essentially to arrest the fall in the stock price. That did not happen. Do you think actions like these, suddenly you change your capital allocation policy, would attract some bit of attention from the regulator, SEBI, as well?
Not exactly, because in a way I would believe that what Vakrangi has done is correct, because the whole idea of a buyback is to essentially arrest the price fall, and I think they all learned from the lessons of PC Jewelers that just by announcing a buyback price you don't arrest the fall.
The whole idea of the buyback should be to reward shareholders because you have cash on your books, right? No,
see, the point is, I can understand when the stock is at a certain level, let's say 500, 600, it's a different thing. But when you're buying back 120, whatever is the current price, or 90, I don't know what is the current price, I think people can go in the market and buy. What are you going to do? Are you going to buy it 40 rupees higher, 30 rupees higher? See, Feb 12th and today is totally different. I think from Feb 12th till now it's down about 70%. So what is the point of going for a buyback? And I think, in my view, companies like Vakrangi don't need to do a buyback. Vakrangi is not a TCS. See, TCS has got billions of dollars on its books. It needs to use the cash. Vakrangi, in my view, should actually invest in expansion. I don't know why they came up with the idea of dividends. I don't know why they came with the idea.
But this is misleading their shareholders, right? First you announce a buyback, then with your earnings, which have come out late actually, then they're saying, no, we're going to change our stance and look to invest that money into our business now.
They've actually mentioned some bad debts. Until now, they were always saying all government-related projects, there are no bad debts that we face, because till the time the government of India keeps on paying, we're not incurring any of those. There are a lot of chinks in the armor right now.
What I understand is the bad debt you're talking about is the write-off they take on the e-governance business.
Yeah.
See, they are virtually winding up the e-governance business, so that is a write-off they've taken.
But why would you write off money that is coming?
They are like power dues. If they don't come, what do? They got to write it off. See, that's a risk in government projects. And if you deal with government projects, you will know that there are some monies that just don't come. So you're going to take a hit and take a write-off. But see, I agree with you that there are two things they should have addressed. Number one, they should have addressed why the auditors left. I think that is something they have not addressed at all. Number two, they have to give a reason why they have been inconsistent. Why did they talk about a buyback in Feb, and why did they not talk about a buyback? Now, I think they should have explained those two things. Having said that, I think strategically, if I was an investor, I would still prefer that Vakrangi, invest in expansion rather than doing a buyback. I want TCS to do a buyback. I don't want Vakrangi to do a buyback.
Okay. Let's not talk about whether or not to invest in Vakrangi. It's a risky call. A pit full of snakes, so you don't really know which will turn out. So let's avoid that displeasure right now.
That's right, and we'll see if the stock, how it opens today to its changing in stance of capital allocation today. Neeraj.
Yeah, let's wait and watch. But more than Vakrangi, there are a bunch of other stocks that we should be watching out for in trade today as well. So let's go across to our research desk to try and figure out what are the key names to watch out for, aside of TCS, aside of Vakrangi, and maybe a few other names as well. Nikki, Shraddha, as well as Darshan join in to talk about all of those key stocks in news and the ones to watch out for. What is it, Shraddha, starting off with stocks in news?
Yes, just more of an update on ICICI Prudential that will remain in focus today as well. And that's because ICICI Bank has said that they will exercise that over-subscription option to sell another 1%. So overall, in line with that up to 2% stake sale approval that had come from the board. Two contract wins for Wipro. One is from Latam Cargo, one is from Nokia. Now, Tamil Nadu Newsprint has said that they will incur a capex of 2,520 crores on expanding various capacities. So watch out for that name. There seems to be some development on ICICI Bank. ET report says that former Supreme Court Judge B.N. Sri Krishna will conduct an investigation into the entire Chanda Kochar controversy. Remember, on 30th May, the board had ordered an independent inquiry, and that was after a whistleblower complaint. You also have a Mint report which is saying that ICICI Bank's nomination panel is readying a succession plan for the CEO. In fact, they've said that the committee may appoint a headhunting firm for shortlisting a new CEO, and the terms of an appointment have been discussed. So let's see how that one reacts. Also, GPT Infra projects in the back of a bulk deal where Ampersand Growth Opportunities Fund has sold 0.68% stake, and you have Saturn Credit Care Network where Goldman Sachs Singapore has bought 0.73% stake. The seller is DBS International. No big moves likely on many of these.
Yeah, well, so maybe not on some of the smaller ones, but could there be a big move on the big one, Darshan? Dr. Reddy?
Yeah, so basically what has happened is, the stock has already moved 16-17% on the anticipation of the launch of this drug, and we've written an article about it. So finally, the US FDA has approved that drug. Suboxone film has been approved. But remember, it's not only Dr. Reddy, Mylan has also gotten the approval, and it's an approval on an ongoing litigation. That means they will do an at-risk launch. Dr. Reddy has already come out with a press release indicating that they plan to do an at-risk launch. So what will happen is that they will get the money, but in case they lose this case, the damages will be 3 times penalty what it is there. So that's a big risk that they are taking. Now, Indivior is the innovator for the drug. The brand value is $1.7 billion, and the market size is $800 million because of competition that's coming in. The brand size is $800 million. What our brokerage is saying, Nomura is saying that if there was no competition, if only the innovator is there and Dr. Reddy launches and Mylan doesn't launch, that would mean an EPS impact of EPS accretion of 62 rupees per share. But if Mylan also launches or any other competition comes in, that means it drops to almost 37 rupees. Investec is of the view that since Dr. Reddy got the approval in all the four in all the 4 strengths, it's positive, but damages are something that they will have to incur if they lose this risk. As far as competition will probably come in now, because Teva also has approval. There are other companies which also have approval, and they are recommending selling out the counter, because the counter has already moved up 16-17% on the anticipation of this drug.
Oh, interesting. So whether or not at risk or otherwise, the stock has run up, and therefore maybe book profits.
Yeah, so it will definitely open gap up, because the development is positive. Whether it will stay or no is anyone's guess, because what we saw with Sun Pharma and Biocon also, that some of the time most of it is already factored in, so it cools. I don't want to take a guess on what will happen, but that's what Investec is saying. It's already run up 16% on the anticipation that this drug approval will come in. They will launch it at risk, so I think they feel it's factored in.
Okay, we'll ask Hari about this as well, but before we do that, Nikki, CIET, a stock in focus as well today.
Yeah, so annual investor conference was held yesterday where the management reiterated the growth outlook and the capex plan. Now the company is undergoing a very significant capacity expansion plan where it's planning to expand capacities in the truck and the car tire segment, along with the ramping up of capacity in the two-wheeler segment where it has a good market share of 28 to 30%. What brokerages suggest on that, we have Deutsche Bank, which has maintained a buy rating on the counter, but has cut the target price from to 1,800 from rupees 1,950. It says that the capacity expansion will definitely lead to incremental market share, but at the same time, this will also increase the cost of the company at least by a good 3 to 4% sequentially from Q2 FY19. Along with that, it will also put some pressure in terms of its cash flow. It does prefer other two tire majors, that is Apollo Tires and MRF in this space. Macquarie on CIAT says that it has maintained the kind of rating and also the target price it has over the counter. It says that the management expects a revenue CAGR of 12 to 17% over the next 5 years. The capex is expected to peak by FY20, which is going to be funded through internal accrual means, and the EBITDA margin, importantly, is expected to improve over FY18 to FY21. They expect a 26 EPS CAGR in the next 3 years, FY18 to 21, led by 12% growth that we've seen in revenue.
Okay, watch out for this one as well. Thanks all of you for giving us those updates. Hari, I can ask you about multiple stocks, but Dr. Reddy's is the first one. Start off likely to be much higher than what the price was, or higher than what the price was yesterday. Can it sustain?
See, I think broadly the story would remain the same, be it, Reddy, Lupin or Sun Pharma. I think at least the short-term bounce, as I see, would probably face the resistance. But I think, as I again said in the case of Lupin, the long-term story, I think, at least seems to have bottomed out. It may not get into a kind of a frenetic bull rally or anything, but definitely I think the worst at least seems to be over for pharma.
Okay, let's wait and watch whether the worst seems to be over for pharma or not. But as per a report I was just reading, it said that earnings for the pharma companies for FY18 have fallen 30%. So let's see whether it's only about earnings contraction. But most of the analysts are also of the view that the multiples of these stocks, that has not contracted alongside earnings. So we'll wait and watch for that. But it's time for us to get in our technical experts. Shrikant Chauhan, Senior Vice President for Technical Research at Kotak Securities. And also joining us on the show is Raja Venkatraman, Chief Technical Analyst at Chart Advice. Good morning to both of you, gentlemen. Let me come to you, Raja, first. Yesterday was not a great day for the markets. We did see some bit of, sell-off coming in the last two sessions, and at least in the last 5 sessions, if I observe, 2 days when we were actually approaching the 10,900 mark, we couldn't touch that mark, and there was some sell-off which was coming at higher levels. What is your reading on the charts now in Nifty?
Yeah, I agree with you on this point. If you recall, last week also I had said that we need a closing about 10,850.
Right.
And since April and May and once again in June, we are seeing that the 10,850 level has not been surpassed convincingly. And in this week, the interesting thing was the large caps. Reliance moved up, TCS moved to new high, Infi, all the heavyweights, and supporting them were the pharma space. But apart from that, there was not really much movement seen, and the market breadth has been largely neutral to negative. So the overall scenario is still continuing to be a little weakish, and I would continue to maintain a buy on dip and sell on rally approach. So that's why I continue to advocate a two-pronged strategy, like one buy and one sell. That's the best way to approach the market.
Okay, fine. We'll get to your individual stock ideas for the day, Raja. But before that, let me go across to Shrikant and take his view on the frontline indices today. Shrikant, would you take any trade today on Nifty or on Bank Nifty?
Good morning, everybody. Navneet, I think the overall formation of the Nifty is very clearly range bound, but it is finding a lot of resistance at higher levels. At the same time, 10,765 acted as a very good support in the past when the market was down. It was like failing to cross the level of 10,765. Yesterday also, when there was a weakness in the market, it was very close to those levels, and from there it recovered back. So today we are going to see that whether the market is holding this level or not. In case if we see the market is breaking to the levels of 10,765, then the next level to watch out for is between 10,700 720. So in that case, I would like to go short on the market. But if we see the market is holding above this level, then the chances of again hitting 10,830 835 would turn bright. And in that case, we'll take a stock specific view. If we see any higher opening close to 10,830 835, because nowadays SGX Nifty is not indicating or suggesting the right picture of the opening level for the market. So if we see the market is opening close to 10,830 850, then there certainly we should look for creating short positions on the market, because I'm not expecting market to cross even 10,900 so easily.
Okay. 8:50. Before we get into specific stocks, it's time for our special segment Bloomberg Edge, wherein Jayesh Kilnani tells us about a pattern that the Bloomberg terminal has thrown up on a stock. And Jayesh, what's the stock on the radar today?
Morning, Neeraj. It's Max Financial. That is because the stock is down 20% in the year so far and is now facing resistance at its 100-day moving average. And with yesterday's close, the fear and greed indicator has in fact given a sell signal. Let's have a look at the fear and greed indicator and what are the conditions that you have to keep in mind. It's a proprietary Bloomberg indicator which uses the spread of two weighted moving averages of true range as one of the key inputs for calculation, and it oscillates on a zero baseline, therefore becomes becomes very easy to interpret. So you have to follow the color for your buy and sell signals. You buy when red turns into green, and you sell when green turns into red. And this is exactly what has happened on the chart of Max Financial. Let's have a look at the chart. You can see that there has been a steady decline in the year so far, and the bottom panel shows you the fear and greed indicator. If we zoom into this, there is a slight bit of red tick over here, which is the last one, which indicates that there could be a potential sell signal on the cards.
Interesting. And what about back testing, Jayesh?
So Neeraj, back testing for last 1 year shows that profit would have been about 30 to 32% if you had sold all the indications.
Wow, we'll wait and watch for this. Max Financial, thanks a lot for that, Jayesh. Select financial names, insurance names under pressure, and we'll talk about them with Hari. But let's first get in some chart checks from our experts. And Shrikant, I'll come back to you first. What are the stocks that you're recommending today?
Neeraj, I would like to go with those stocks which are not part of index and they decide their own trend. We like VIP Industries, which close around 455, 457 levels. On daily basis, the stock closed into new territory. It is heading for at least 500 in next few days. But in the near term, I'm expecting 475. On the downside, 450, 451 is going to act as a very good support for it. So with the same stop loss of 450, if we create long positions, then I think that should do well for intraday traders. But if there is a medium-term view, then I am of the view that we should look for adding the stock to our portfolio because it is heading for at least 600 in next couple of months. The other stock which we like is Mahindra & Mahindra, and here the formation is quite interesting. It is forming symmetrical triangle on daily basis. The stock is continuously narrowing down its trading momentum, and in next 1 or 2 days of time, maybe today or tomorrow, Monday, we can see some activity in the stock on the upward side. So it's a buy at this price with a stop loss at 910, and we can expect a target of 945. But in next few days or few weeks, we can even see the levels of 1000 on Mahindra & Mahindra.
Okay, so those are two buy calls coming in from Shrikant. Raja, you mentioned you've got one buy and one sell for the day.
Yeah, so I would like to go in with the pharma space because that's bucking the trend. And from that, I pick out Walk Pharma because it's made a double bottom on the daily charts, and valuation level around 710 has been surpassed quite successively, and you can expect a target of almost 10 to 15%. But then you can use it as an intraday play or as a positional play. So targets of around 830 to 840 is envisaged. So that's a good strong move because other pharmas have moved, and this setup is quite positive. And if the pharma space really moves with Dr. Reddy News also seeping in, that could definitely do well. And the other sell call, I'm again reiterating a sell on Adani Ports. A rally continues to remain a sell, and a move today below 375 would definitely augur more weakness, and it could see a drop towards around 360 to 355 levels.
Okay.
With this good trend line breakdown.
One buy, one sell coming in from Raja. Let's just talk about some individual stock. ICICI Prudential was weak in yesterday's session. If possible, if you could just pull up the June futures of the same. There was a major build-up seen in terms of open interest for ICICI Prudential. It's been trading in the negative territory for the last two sessions. Look at that, 92% higher, indicating that there are fresh short positions being taken. And remember, there was news that ICICI Bank is looking to sell nearly 2% stake in the company. Hari, what have you made of the news? Because ahead of that, we've seen some, shots being built up for both, not only for ICICI Prudential, but even ICICI Bank was weak yesterday.
See, I don't think it has got much to do with the sale, stake sale, because the kind of I would say image problems that ICICI is facing right now. If it sells a stake, I think it should be positive for Prudential rather than being negative. I think the bigger problem is that the market is expecting some compression in growth in the next 2 quarters on ICICI Prudential. In fact, the early numbers coming out from Prudential in the market are that the offtake of sales has not been too great. So next 2 quarters, I think the numbers are going to be in pressure. And I think this open interest build-up as IC, the short interest, is more a response to the likely weak next 2 quarters rather than the sale of stake.
Interesting. There's also talk of this succession plan being drafted by the board for ICICI Bank individually. How does that augur? My broad question is, there could always be a 5, 10, 15% downside in a long-term stock, Hari. But are the valuations and the price correction in ICICI Bank indicative of almost all of the bad news in the price?
See, we really don't know what is the bad news. I think that's the problem.
Yeah, whatever is known right now.
Yeah, so whatever is known, I would believe probably another 10% lower, it should probably be, I think, a good stock. But I think there is something larger we need to understand. See, for a very long time, ICICI Bank has been what I call the driver of the entire private banking space, with the largest loan book, the aggressive growth. I think that it has lost to HDFC. Today HDFC Bank's loan book is about 25% larger than ICICI Bank's loan book. So I think when you lose leadership, you lose valuation. So I think that is what is probably going to weigh on ICICI. And if you look at it, probably Kotak is almost valued at, I think, as much as ICICI Bank or slightly more. I don't know what is the exact valuation. So I think the problem with ICICI Bank was it was always a bank that was known for its aggressive growth. And today when the bank is losing out its aggressive growth, whatever basic valuations that it had, I think also that's coming under question. So I don't know. I'm hoping 10% downside should be a good stock. But even a 10% downside, whether you should buy the stock or buy some other bank, I would not be too sure at this point.
So then what should you buy? Just recently looking at the commentary, somebody tweeted about it's a dated one, but the annual report of Kotak Bank and how the Kotak is saying that they will sustainably grow at 2 times the nominal GDP. Rashesh Shah in earnings interaction told us that all businesses will grow 3 to 5 times by 2025. Equitas is talking about a 30% CAGR for the next 5 years. If you had to bet on one financial name for the next 5 years, what would that name be?
See, and why? If I want to really be conservative, I would bet on HDFC Bank, because I still think that that is one banking stock. Come what may, at least in the next 5 years, I don't see any negative surprises. I don't see corporate governance issues, at least as of now, and I think that's a very, very important point as far as banks are concerned. So obviously, I would bet on HDFC Bank. If I was to look at a slightly higher risk, higher growth, I think IndusInd to me looks to be a very, very good bet. And probably IndusInd is what HDFC Bank was probably 15 years back. So I think from that perspective, if you ask me to bet on a growth stock, I would bet on IndusInd more than anything else.
Okay, so you're playing safe with both your options among the private banking space. One is HDFC and the other is IndusInd Bank. Pull up Dish TV. In a weak market like yesterday's, Dish TV managed to close in the positive territory. In fact, day before yesterday, we learned from the block deal data that Rare Enterprises had bought, I think, 0.7% stake in the company. Shrikant, let me come to you. A quick thought on the charts for Dish TV. Do you think at these levels, fresh long positions can be taken?
See, for Dish TV, the level of this 65, 60 around has played a very important role in last almost 2 years. And again, when there is a fall and the stock is very close to those levels, we saw a good amount of volume, block trades, block deals. So it clearly shows that it is holding around these 60, 65 levels until the stock is not breaking the 60 as a mark. I think it is going to remain range bound, or again this stock can resume some rally, but we are not that bullish on the stock because overall performance is not that impressive. From here we are expecting again maximum somewhere close to 85 if we take a view of next 3 months. But otherwise my view is that it is better to focus more and more on Z or PVR, where there is a very clear cut formations. PVR especially is forming symmetrical triangle on monthly basis. So there I am expecting at least run up of 10 to 15% in next few days or weeks. So PVR looks really good. At this price, if there is a long-term view, then only one can look for adding Dish TV to their portfolio.
Okay, watch out for PVR and Inox Leisure as Race 3 also releases today. Let's see how that fund performs. But just a few seconds to go for the pre-opening rates to come on your screen. SGX Nifty has slipped further. Actually, it's down 28 points right now. Those are the initial pre-opening rates for you on the screen. It's showing a start above the mark of 10,800. But remember, these rates will settle down by 908. Let's just look at the individual stocks among the Nifty constituents. Infosys is down another 1.5% in the pre-opening session today. What's also in the negative territory is something like HUL, Hindalco, ONGC. All these stocks are suggesting a negative start. But on the upside, Dr. Reddy's, that's the stock which is going to be in focus after they've received an approval from US FDA for one of their drugs. 3.5% higher for that one. Let's see if it can sustain those gains. ICICI Bank is in focus. That too is suggesting a positive start. HDFC, Cipla, and you've also got your heavyweight like TCS. That's also trading in the green, at least in the pre-opening session, Neeraj.
Well, let's bring up something else as well. I want to see what Vakangi is up to, really. It's that one stock that I really want to see whether it's reacting negatively or no. Oh, no, it's not. It's up about 5% odd. That's interesting. Maybe the market is taking it well. Yesterday, the belief, at least amongst the Twitterati, was that this isn't exactly what they were hoping for or thinking about. Let's wait and watch. Strange things do happen, or interesting things do happen. People can be mistaken. We've spoken about Dr. Reddy's. Bring up the rest of the pharma pack as well. Wockhardt was a recommendation by Raja. Let's bring that stock up as well, because pharma by and large seems to be in a very sweet spot for now. A couple of names starting off soft, but these are pre-open rates. Yeah, will change or can change. ACC showing that unnatural 7% downtick. I think it'll correct itself. 1% placed under additional surveillance measures. Maybe that's the reason why the stock, after being in the green in trade yesterday, is starting off 5% lower. Let's wait and watch. Tata Elxsi had some very strong days. The last 2 or 3 is coming off today. And in today's session, I think JK Tires, amongst other companies, is doing rather okay in the first few minutes of the pre-open session. Let's wait and watch if these tend to correct. Last but not the least, a couple of stocks that really shot up in trade yesterday. Mahindra Logistics was up about 6.5% odd at all-time highs. Let's see if it's taking off from where it left off in the first few minutes of the pre-open session. So Mahindra Logistics would be the first one, and Sasken Technologies was the other one which hit fresh highs in trade yesterday. Let's see what Sasken is doing in the pre-open session. Not too much. We'll give these rates a chance to stabilize. Just want to mark just want to mark the currency as well as the bond yields. 67.89 if I'm not wrong, 94, so almost back to 68 after that technical pullback that happened due to the perceived HDFC Bank demand by FIIs, or the currency demand for HDFC Bank purchased by FIIs. We lost almost 100 odd basis points out there on the rupee. So that is one. And two, the bond yields, let's see where they are trading at, 7.92. So after nudging that 8 mark, the bond yields have stayed largely stable.
You know, yesterday a lot of these emerging market currencies had seen a sharp fall. I think the Argentinian peso as well as Brazilian real, they were sharply down in trade. Probably that's the reaction that one can expect for the emerging market currencies going into trade today. But for the time being, let's get to the big brokerage calls for the day, and to take us through the same, Samit Sarkar joins us. Samit, over to you.
Good morning, Navneet. On the big brokerage calls for the day, first we have is Investec on RBL Bank. Now the brokerage has maintained its buy rating on the stock, but have raised the target price to 660 from 630. Now according to the brokerage, the bank is rapidly scaling multiple partnerships, thereby creating a niche for itself in the credit card segment, and these partnerships will be a source of high profitability for the bank over a long-term period. Now, however, for the short term, that is for the next 4 to 6 quarters, the brokerage is expecting some drag on the operating leverage because of the dependencies on these partnerships. Now, the brokerage says that the visibility of improvement of return on asset is high over the next 2 years. Lastly, it is expecting a 10 basis points improvement in the return on asset every year and a 40% profit CAGR going forward. Second, we have is Deutsche Bank on UPL. Now the brokerage has maintained its buy rating on the stock with a target price of 890. Now according to the brokerage, the cross currency movement of Brazilian real and US dollars is still in favor of UPL, and the stock correction in the last 1 month is overdone. Now the brokerage is expecting the company to meet its constant currency revenue growth guidance on the back of favorable base in India and the Latin America business, and on the back of strong growth expected from the North America business. Now it is also expecting the company to maintain its margins, to expand its margins going forward on the back of the backward integration plans of the company. Now UPL's EPS is expected to grow at a compounded annual growth rate of 18% over FY18 to FY20, and the company still trades at a discount to its global and Indian peers, and this makes the stock a preferred stock in the Indian agri and space according to Citi and Deutsche Bank.
Okay, Samit, thanks a lot for bringing those big brokerage calls for the day. Just pull up Infibeam. Remember yesterday we did highlight towards the end it could enter into the F&O band, but that's not happened actually, and there was a unusual build-up seen for the far-month futures, that's the August futures of Infibeam, but a lot of shedding was seen for the June futures towards the end, and that's the reason why I didn't enter into the F&O band. So 154 for this one, but Raja, last week I remember there was a sharp correction seen for this counter of nearly 10%. How is it looking on the charts?
It's still looking weak, and it's developing into a flag breakdown on the technical parlance, and if it moves below the 143 levels, it could actually attract more selling pressure. So the movement also has not been, it's been iffy and not much participation has been seen. So overall, the weakness continues to remain.
Okay, interesting. Couple of stocks. I mean, don't get perturbed by United Spirits. That's a technical adjustment out there as well. But I'm just looking at. So that's not really the stock I want to focus on. ITDC, after a 20% uptick in trade yesterday, is just cooling off a little bit. So after 3% down in the first few minutes of the pre-open session, and this is what typically would happen. The stocks go up because of a belief that divestment would bring in a lot of benefits to minority shareholders. Typically doesn't pan out exactly in the same fashion, so do watch out. By the way, the one that is really starting off well is Dr. Reddy's, up about 2.25%. So that's reacting all right to its news. Shrikant, for somebody who was a long in Dr. Reddy's, because 3 days ago or 2 days ago we put out this news on the website as well that the market is probably missing out on what is likely to be a launch, successful one from Dr. Reddy's. So maybe a few people went long. Would you stay long on Dr. Reddy's if you already are sitting on longs, or would you book some money out?
See, if there is a trading view, then certainly close to 2250 levels, so one can look for taking some profit on Dr. Reddy. But if there is a medium to long term view, and if like somebody or if someone have bought at higher levels, then our advice is that to hold on to the positions, because the broader outlook for pharma is turning positive on technicals. Volume as well as price patterns are clearly indicating us that almost all stocks have formed double bottom and they are reversing back. We were discussing on Lupin Laboratories a few minutes back. So definitely Lupin is going to outperform in this space. But Dr. Reddy as well as Sun Pharma, they are also going to give minimum 15 to 20% return in next few months. So if there is old positions, or if there are any investments, just hold on to that. But for trading positions, I think 2250, 2270 is the next level to watch out for.
Okay. That's the view coming in on a couple of these pharma stocks. Hari, if you track Jubilant Industries in the last two sessions, I think on Wednesday it was locked in upper circuit. Yesterday there was some 18 to 19% gains. There's no news which is coming, at least on the stock exchange's website, but anything happening here?
Not that we could really track, but historically that stock has been quite volatile, so I'm not surprised by the moment. But frankly, I don't think we caught any specific news or anything about that stock.
Okay, Raja, anything on the charts you're spotting for Jubilant Industries?
It's actually given a good breakout on Wednesday, and since then the positive moves which are appearing are definitely indicating a move towards 850 levels.
Okay, let's see how that one opens today, whether once again there's an upper circuit or not for this one. But a lot of these infra stocks were active yesterday too. So something like Ramki Infra, that went up in trade. That was up nearly 10 to 11%. And overall also, once again, Hari, that affordable housing theme has, come into focus after the reject that's happened with regard to the Prime Minister Awas Yojana scheme. What have you made of it? And do you think we've seen the stocks rallying a lot post, I think, last year's budget. But do you see any groundwork happening on affordable housing?
I don't know, because what I realize is that the framework is there, but I don't think there is much that has actually happened, because what a lot of banks and financiers I speak to tell me is that it's a very, very difficult kind of market to finance. So they would still prefer, the second-rung cities or the top-rung cities. But low-cost housing, they say, is because first and foremost, credit assessment becomes difficult. Okay, number two, managing the credit, the cost is too high, so it's not possible to give it at the affordable rates that they want. So as a business model, people are still not too sure. So I think from the government side, the go-ahead is there. The problem is from the financier side. Ultimately, affordable housing has to be financed. And unless there is a proper business model, I don't think they're able to finance. But I think what the government is talking about, doing a strategic sale of certain companies, using the excess land for local, I'm not sure whether it is going to really work, because most of these factories and all are going to be in places where nobody would want to really live. But, I think as a concept, it is good. But as I said, the whole problem seems to be stuck at the finances end.
Okay. Maybe, well, I don't know if deep solutions lead to some some just rewards for companies which are trying to do some good work here. Let's wait and watch. Anyways, less than 5 minutes left for the markets to kickstart. Let's tell you all that you need to know to stay ahead in trade today. Dr. Reddy's and Mylan get the US FDA nod for $1.7 billion addiction treatment drug. The street watches whether the companies will do an at-risk launch. Dr. Reddy's confirms it will do an at-risk launch.
E-commerce solutions provider Wakrangi to buy and upgrade 45,000 ATM cages, allocating 2 lakhs each for every ATM.
ICICI Bank mulls exercising oversubscription option to sell additional 1.43 crore shares in ICICI Prudential Life.
And Goldman Sachs buys 0.7% stake in Saturn Credit Care Network, while DBS International sells.
In brokerage calls, Investec raises RBL Bank's price target to 660 rupees from 630 rupees per share, as the bank is creating a niche for itself in the credit card segment, according to Investec.
And Avenue Supermarts says that it's unrealistic to expect same-store sales growth to continue at 20%, while adding that it plans to pass on the future benefits to its consumers.
And that stock starts off lower too, but hey, Wakrangi Software does start off 5% lower. Keep that at the back of your mind. Magma FinCorp, some interesting money has gone into it. The stock is down about 5% in trade today, 163. Raja, quick chart check here. Can you pull up Magma FinCorp?
Yeah, Magma FinCorp is actually trading into resistance around 182. So
182, but currently at 153, right?
Yeah. So it has got room till 182, and there is some positive momentum seen. So one could actually look to play long towards 182.
So it's starting off 5% lower today. Would you buy into it?
Yeah. It's still a good buy opportunity.
You would buy into Magma
because it's formed a good support and it's actually heading higher.
Interesting. Okay.
Yeah.
Shrikant, a stock like Ujjivan Financial Services, which about 2-3 days ago was looking good to certain people at 406, 410, has come back to 390 odd. What would you do with an Ujjivan?
See, for Ujjivan, we have a bullish view, and we are of the view that if there is a positional view, then certainly one should look for adding this stock to the portfolio, because this stock has reduced its volatility completely, and it is holding well above the mark of 380, 385. Yesterday also, when there was a weakness in the market and market was down, it was around 390 levels, but from there again it recovered back. So for the day also, we are of the view that we should look for adding this stock to trading portfolio with a stop loss at close to 389, 387. And again, we can expect 410, 415 on the high side. But if we take a broader view, then Neeraj, I'm telling you, this stock is definitely going to do well. And we are expecting stock is heading for the levels of minimum 500, 530.
Okay. Hari, very short time. We'll take in a detailed answer in a bit. But a quick answer first. Reliance Industries, 1006, near around those closing record highs. Would you buy into it?
See, I would still wait for it to sustain about 1,000 for some more days, because the good news was there in the last telecom numbers. I think it has crossed Idea. It is probably very close to crossing Vodafone. The good news is there in the telecom numbers, but I would still wait for the stock, because 1,000 has been traditionally a very, very big resistance for the stock. So I would wait for the stock to kind of sustain above 1,000 and break with volumes. I think that is when we would really buy Reliance.
Okay, very quickly, let's get the top trading call from our technical experts. Raja, one stock that you will bet on?
Walk Pharma.
Walk Pharma. Shrikant, what about you?
VIP Industries.
Okay, so both the trades walk hard as well as VIP, our technical experts are suggesting on the buy side, Neeraj.
Thanks for that, Navneet. Well, the basic indices are starting off extremely flat. I don't know if there would be a trade that our experts would have on any of these. So maybe I'll refrain from asking that. But maybe, Shrikant, a very quick 10-second view. Would you take a trade on the Nifty Bank at all?
See, for Bank Nifty, we are of the view that it is in a range, and 26,400, 450 is going to act as a very good support. Till then, it is not going to give any specific trend. So my view is that if there is any correction, then close to those levels, create long positions, contra positions of going long in Bank Nifty, close to 26,450.
Watch out for those levels, 26,450, and here's the start, 26,536. So it's a very flat start for almost all the key indices, including the Nifty Bank. Doubt that the mid caps and the small caps would be doing anything dramatically different. Pull up the broader end of the spectrum indices as well. Flattish start. Remember, they were very flat in trade yesterday as well. Slightly better than what the large caps did, of course, but very flat in trade yesterday as well. Bring up the heat map. It promises to be a dull start. We don't have too many stocks moving around, save for Dr. Reddy's. Let me start with the green for a change. Dr. Reddy's up about a couple of percentage points. So that's the only one on news. You could argue that ICICI Bank is a newsmaker, but hardly any move there, just about 1% or thereabouts. TCS on the day of the buyback is up about 1% after a 2% downtick in trade yesterday. And that aside, no, not too many. More red than green on the screen, but no alarm bells. Just that the red is slowly enveloping in a meaningful way. But again, if you look at the lower row, which is the top losers today, we don't have too many losers. L&T about 1.5%. That's about it. But the rest of the names, well, hardly any moves. So no big gainers, no big losers. The stocks in news, Reddy's, TCS and ICICI Bank occupying the top draw and the gainers list. So, well, that's interesting. But the indices by themselves, extremely flat, no great movements, no knee-jerk reactions at all, none warranted, none expected either, but a very, very flat and a sedate start to almost all of the large cap names. I doubt that the mid caps and the small caps would be doing anything untoward as well. Save for Vakrangi, I just want to mark one stock before I hand it over to Navneet. Let's try and bring up Vakrangi software out here on the screen. Starts off 5% lower in trade. Navneet, what are you spotting?
You're only going to see 5% lower or 5% higher for a stock like Vakrangi, Neeraj. So that's the lower circuit. But a couple of stocks from the broader markets. I think you've got ITDC, which is up another 3% in today's session. Remember, the stock's been active so far this week. Kesoram Industries is also seeing an uptick of nearly 4% in trade. KRBL, that's up over 2%. And something like Eros International. Also, you've got Inox Leisure. Both of them are starting the day at least in the positive territory. Even RCF, that's seen some positive ticks in the opening session. On the losing side, India Bulls Ventures, that's down nearly 5% in trade. Also remember, Manpasand Beverages, that's been placed under the additional surveillance measures by the exchanges. This news came in yesterday, so that's reacting negatively. And Quality once again is trading lower in trade. BPCL is down about 1% in trade. And DB Realty is also seeing some negative ticks. In terms of stocks and news, if you could just pull up Satin Credit Care Network, where Goldman Sachs Singapore PTE has acquired 0.7% stake in the company. So that's reacted positively to the news. And also something like GPT Infra Projects, where there was some fund buying and selling seen in yesterday's session. So GPT Infra, not too much of a positive tick there, trading only with gains of 0.5%. So can we just pull up the India Volatility Index as well? Because the VIX has been correcting a lot in the last few sessions, and finally it is trading below the mark of 12.5, which is a positive sign at least for a lot of these derivatives analysts. So let's quickly get in the first thought on the opening rates. We're still hovering around the mark of 10,800. Shrikant, now tell me, are you going to take any position on the index or no?
Navneet, I think there is no point in taking any positions right now because the market is in between. It is not breaking the level of 10,765, neither it is trading above the mark of 10,810. And if you see the overall formation, then today stocks which are down are like heavyweights like Larsen, Grasim, BPCL, IOC. These are all like pulling the market or keeping a lot of pressure on the market. So till the market is not sustaining well above the mark of 10,765, it is better to stay away. Be stock specific. There are like few stocks which are doing really well. We have to focus on those stocks.
Okay, very quickly, Raja, anything interesting popping on your screen after the opening rates?
Yeah, the buy in Wow Pharma continues to do well.
Okay.
And if you go for the index, I would say you could mark out the first half an hour range. And if it really breaks down below, which I feel it will, you could actually initiate a short, either on the Nifty or on the Bank Nifty.
Okay, that's a view coming in on the opening ticks. On that note, I would like to thank both our technical experts, Raja as well as Shrikant. Thanks a ton for joining us this morning and have a great weekend.
Thank you.
Well, in terms of other stocks, pull up HOEC. I remember the stock going up in yesterday's session as well. And I think today's opening too has been on the positive side. Hari, if you track this one, it's up nearly 5%. I remember a year back, there were some expansion plans going for HOEC.
No, I think the expansion plans are on.
Yeah.
That's on. I think what's probably working in favor of HOAC is that the company does work a lot on the exploration side. And, you know, the investments are finally coming back into oil exploration with oil at about $70 to $80 a barrel. And the investments seem to be coming. So that's, I think, positive as far as the sentiments are concerned. it needs a little bit of support on the policy front. I think policy is where HOEC is probably, falling a little short. And if you look at most of the upstream oil companies, be it ONGC, be it oil, I think all of them are under some kind of pressure. But I think otherwise, if you look at it, the investments are increasing, and that is going to be positive as far as HOEC is concerned.
Okay, so we'll be watching out for that one. Thanks a lot, Hari, for joining us today and taking us through your views on individual stocks and also on a couple of sectors. Venky's India, that's also locked in upper circuit with gains of 5%. So keep an eye on that one too. And something like JBF Industries, this too has been quite active for the week. So JBF Industries also showing a tick of nearly 5% in trade. And Nifty is still hovering around that mark of 10,800. Let's move on and get our next guest on the show then. Rajat Jain, Chief Investment Officer at Principal Mutual Fund, joins us on the show now. Hi, Mr. Jain. Good morning to you, and thanks a lot for joining us today on Bloomberg Quinn. First, a word on the macros, Mr. Jain. We've seen some emerging market currencies depreciating yesterday from the likes of from Argentina or Brazil. This morning too, we've seen some depreciation coming in for Indian rupee, and there are some headwinds revolving around higher crude oil prices. Also, inflationary pressures for India, they continue.
Truly. Oh, well, I think that's true, because I think Indian macros were very good last year if you look at through calendar 17. So clearly we are not as good, and there is some deterioration, and which ultimately certainly will result in higher current account deficit. If you saw the current account deficit for the last quarter of financial year 18, we came in about 1.9% of GDP, and likely will be something similar or slightly higher for FY19 for the full years probably. And clearly inflation, though I think inflation we have to see how it, for the full year, how it pans out. The core part of the inflation has been going up a bit. That's a bit of a concern. Fuel prices clearly have a bit of, are certainly going up, but also vegetable, fruit prices and core really, which I think is a concern. So overall, yes, macro is not looking so very great as what it was last calendar year. I think the market sort of pricing that in, or I wouldn't know. I mean, it certainly is aware of it, and that's one of the reasons the market has been a bit of up and down.
Mr. Jain, though the markets have been pretty volatile in the recent past, but overall, what's your reading being? Because we've seen support continuing from the domestic institutions at least.
Truly, I think yes. What we have seen is that the investors, the retail investors who have been coming into mutual funds, while there's been some damping of flows, but they still remain positive. I'll speak, say, for our fund house, and we're still seeing net positive inflows. So I think that remains. And we know the markets are okay. They may not be cheap, but they are not in bubble territory. So we are not seeing valuations where the markets are trading at say 24 or 25 times forward earnings. If you look at the market's valuations, market may be say 18 and a half times forward earnings. So it's not, I mean, it's at a premium to long-term valuation of say 16 and a half or 17 times, but we are not in bubble territory yet. And we are seeing the micro environment clearly, especially on the consumption theme, look better. There's a lot of expectation from the rural areas, particularly given the anticipation of a decent rainfall this year. And higher MSP prices, government work in terms of work on the road projects, which certainly does ultimately percolate down in terms of spending in the rural economy. So all of that sort of comes together. So we have fairly valued companies, decent growth on consumer. Though macro is a bit of a challenge, but fund flows still remain positive, I think, for the markets as a whole.
Mr. Jain, did you face redemption or slower inflows into balanced funds as well?
No, not really, actually.
Oh, okay.
I know one of the strengths that we have is that we have a very, very retail-oriented investor base, and we have not had those large redemptions from our balanced fund category.
Okay. I just wanted to get that out of the way. Okay. Now, what to your mind is, what is your individual earnings expectations, the street is as divided as it can be between 15 to 16% to all the way to maybe 20 to 23%. What do you think we do in FY19 realistically? And what will drive that number? Would it be the performance of the corporate banks coming back to the fore which will lead to this?
Yeah, that will be, I think, okay, the first piece, our expectation of earning is between 17 to 20%. It's still a wide number because things are all over the place, but that's what we think it's going to be. We are not in the camp which has a 23 or 24% sort of earnings growth because although economy is looking good, in terms of the micro at least it's looking good, but higher crude prices could potentially have an impact on the consumer. If you look at the petrol sales for the last month, for example, they were, I think, down about 1 to 1.5% year on year. So probably, so higher petrol prices is going to have, crude prices could potentially have an impact on the consumer demand. So overall, we still think the growth will be substantial, but should be between 17 to 20%, partly because of the base effect, as you've just said, in the case of the corporate banks, because the earnings virtually, we had losses for the banks as a whole, as a category. And so that's certainly going to be one of the things that's going to drive. Other than that, we like the autos and the consumer discretionary space. So auto ancillaries, I think they should do fair amount of earnings growth there as well. And software probably grows of the order of, say, 10, 11, 12% sort of growth likely from there. But substantially, yes, a base effect is going to drive, especially in the corporate banks, is going to have some impact on the earnings growth for next year.
You would believe that the markets will be able to do away with the ex-banking earnings looking robust line this time around?
I'm sorry, Neeraj, I missed that.
No, so quarter 3 and quarter 4, most people were trying to justify their earnings estimates, saying that the earnings are good, ex-banks. Do you think FY19 we won't have the need to use those terms?
Yes. I would think so.
Okay.
I would think so. We would not probably. I think what we are seeing, if you look at the banking sector, most of the recognition seems to be behind us. However, one area I think that people have been talking about certainly is power. So on private generation companies particularly. So that's one area which can still create issues. But outside of that, incrementally we don't see negative surprises in the asset quality, and there could be some positive write-backs as we see the NCLT cases getting resolved. Certainly the first list of 12 actually should see positive write-backs there. So yes, I think the street would need not talk about ex-banks. You're right.
Well, I certainly hope so. Okay, you gave us a brief of the other two spaces where you believe the earnings growth will come about, which is autos and IT. Now, rather calendar year 18 thus far has been mixed for the auto stocks performance, in part maybe also because of the kind of gains that 2017 showed. But the Ashok Leylands, the Marutis of the world haven't really been able to put on some good shows. It's been restricted to select auto components, maybe companies like Mahindra and Mahindra at best, which have shown the metal or shown the returns for shareholders. What happens in FY19 or say over the next 12 months? Do the usual set of winners come back because the monthly numbers and the earnings will still show?
Yeah, I think I'll just make a broader point and then come to these. I think the broader point itself is for the markets, the broad markets as a whole, while they are slightly expensive, they are not in bubble territory, as I've said. However, the weakening macros, the aggressive news flow in terms of the global news flow, in terms of talks on trade, in terms of Indian political situation, in terms of having an elections later this year and the general elections early next year. So all of these will weigh on the market. So our call on the market itself is moderate returns this year. Probably high single digit, though we don't take a call on that, but expect that to be the case. Within that environment now, it will be unfair to expect a certain sub-segment of the market to do substantially better. So our call on autos is a fundamental call. I won't know if they will do very well in the current calendar year. Partly you're right, because of the fact that they have done so very well in the past. I mean, like Maruti or Ashok Leyland have done very well in the past. But the demand looks robust. The valuations are not cheap, but they're not totally out of whack. So, and I think incrementally, are things getting better or worse? I mean, that's the end thing you look for. So still, we think that the consumer demand is holding up. So overall, we think auto ancillaries certainly should do well. But I wouldn't have a call if they would do well in the next 9 to 12 months, say going into March 2019. But over the next probably 1.5 to 2 years, we think auto certainly would be a space which does well.
Mr. Jain, one sector which everyone's been talking about, at least in the last 1 week to 10 days, we've seen some consistent gains coming in from a lot of these pharma stocks, which were beaten down in the last 2 to 3 years because of pricing pressure. Do you think the sector has now bottomed out? Is the move that we've seen in the last 1 week or 10 days, is it convincing?
See, if you look at as to what had happened to these pharma companies, biggest obviously was more than, FDA in terms of quality issues at respective plants. The concern was of the especially US authorities pushing for generics, pushing for lower prices, plus I think the FDA action in terms of quality. I think that seems to be, and Indian companies actually are well-run companies. Indian pharma companies are quite well-run. We clearly needed to improve. We needed to pull ourselves up, improve our systems, which I think the larger companies seem to be getting behind them. We seem to look at the commentaries come the last week. Companies have specifically said that these plant locations are out of regulatory action. So we have put our things in place. So yes, that is, so we always had a well-run pharma space. We are competitive globally. We have good chemists, we have good synthesis skills. So all of that, we have good legal skills, all of that. We had the building blocks in place, but the environment which was, plus our own shortcomings in terms of the quality issues, we seem to have gotten that over with. So yes, it was, the pace of the move was because they were beaten down, a lot of correction did happen. But having said that, I think pharma still has, should do reasonably well over the next 2.5
Right.
2 to 3 years.
Mr. Jain, what the street would also like to know, are you seeing any sort of fund allocation now going to this sector?
To the pharma space, you mean?
Yes.
Yes, I think because while a lot of people had neutral weights, I think a substantial people were underweight pharma space, so there could be some reallocation there.
Interesting. What is it that you are bearish on? You've spoken about pockets where you believe the strength will come in, the 2 or 3, even the limited strength. What is it that you are shunning completely?
It's not, if you look at the financial space, we are not bearish financials. Financials is the largest part of our portfolio, but the benchmark weight is say 31%. We could be around 23, 24, 25%. And I think like most, so what we have is to look at divide into 3 components: the PSU banks, the private banks, and then the NBFCs. Within the PSU banks, so we have the large PSU banks, the private sector banks, yes, we have the corporate banks. And then the NBFCs, however, we've been slightly more selective. There are NBFCs and there are NBFCs. So it's a very, very wide space, but especially given higher cost of borrowing, given premium valuations, while demand still holds good, but premium valuation and increasing competition, and a lot of people have raised capital, competition is there, cost of money is getting more expensive. So we have been selective in picking NBFCs into our portfolio. It's not that we don't have NBFCs, but we do have some medium-sized NBFCs which are experts in their own niche segments. Either they are doing the mid-sized corporates or agricultural, that facing segment, or they have their own niches. So, but generally, as a space, we were slightly more cautious NBFCs in our portfolio.
Okay, Mr. Jain, we'll leave it at that. Many thanks for joining in today and giving us that perspective. Good having you. Look forward to having you more often on this forum.
Thanks, pleasure. My pleasure.
Right. That's, of course, the view from Rajat Jain. The markets flat as flat can be. The mid caps and the small caps too haven't really done too much in trade. It's a very, very tepid Friday, if I can use that term, but not tepid for Vakrangi, or maybe more tepid for Vakrangi, because it's hit a lower circuit after the company announced a change in the capital allocation strategy last evening. Shareholders will not be rewarded with a buyback or a dividend as earlier planned. Darshan is standing by to explain exactly what has changed from the last time around. Darshan.
Yeah, so basically on 12th of February, they came out with a capital allocation policy. They said that they will consider this, and they said they will consider it. They didn't commit to it. That's what I wanted to say. 1,000 crore buyback for, what they want to use their cash. They had almost 1,475 crores. So what they said is that they will consider 1,000 crore buyback, 250 crores for dividends, and 122 crores to reinvest in the business. Now, what happened post the numbers that came in yesterday? They've changed the capital allocation plan. What they've said is first they look to increase the ATM count, and so what their main plan and strategy was that they want to increase ATM. So each ATM cost over 2 lakh rupees. In their 45,000 kendras, they want to install these ATMs. So that's a cost of almost 900 crores. And they say that first the share buyback or the dividend option will be considered only after the first 5,000 new outlets are operational, when they test this thing. So they're saying that they are putting this on the back burner. They haven't put it in black and white that they want to shelve this plan, but indirectly they're saying that first we will look at raising the business or capex or the ATM, then we will consider this. So that's what happened, and that's what got the investors disappointed. Now, what is the new strategy of Vakrangi? Firstly, they are saying that they will upgrade all the 45,000 outlets that they have with this ATM. Now, long-term target is 75,000 ATMs for till 2020. That would mean that another 30,000 ATMs that will come in. So ATM business capex will be ramped up. Each kendra will have an ATM, and that cost is almost 2 lakh rupees per ATM. That means a capex of 900 crores on the existing 45,000 centers, and by 2020 another 500 crores, given the fact that they'll have another some 30,000 new kendras that will come in out. So they're taking no mandate, they're taking no new mandates for the legacy business, and they want to focus only on the Vakrangi kendra. What has happened in the financial this time around is that they've taken a big one-off that is there, and that has impacted the financial. So fourth quarter, there was a one-time write-off in e-governance business which they want to exit now completely. It was a 220 crore loss that was factored in as far as other expenses in the P&L, and that is why their EBITDA took a big hit coming around. So if you're looking at even though revenues grow 61% on a YOY basis, the EBITDA was down 64%, factoring in a 220 crore one-time expense here, and that has also been factored in the profit this time around. But more than the financials, I think it's a change of the management, in which first they had indicated that they will consider a buyback and a share dividend. Now they've changed their stance, and they're saying we'll grow the business first and then consider it. So there's no much more clarity coming in what the company management wants to do, and that is why the stock is down in trade today.
Thanks for that, Darshan. Well, that's Vakrangi for you. Let's slip into a break now. On the other side of the break, we discuss growth prospects for Cyient with President and Chief Financial Officer Ajay Agrawal. Stay tuned. Back with Indian Open right here on Bloomberg Quint. Let's focus on an IT company, Cyient. They want to move on from the legacy services business to a solutions vertical, which currently, I believe, constitutes about 5% of their overall revenues. So much so that Cyient hopes to get almost 80% of its revenue in 10 years from now from the solutions division. The recent acquisition of a circuit design company in Belgium is also aimed at serving this one goal. But will the transition be easy? Or if not, how difficult could it be? And do solutions have higher margins than services? Let's ask all of that to the President and CFO of the company, Mr. Ajay Agrawal. He joins me now on the show. Mr. Agrawal, good having you. Thanks so much for taking the time out and being with us today. Now, the first obvious question, and you addressed this when you did the analyst meet in the first week of May, but for the benefit of a lot of people who wouldn't know, why is this substantial change that Cyient as a company is embarking upon?
Thank you, Neeraj, for having me in, and
Pleasure.
very good morning to you and your viewers. I think that's a very good question. See, let me give you the background of this company. I think, we have been serving extremely good set of customers in Americas and Europe and other geographies. We have extremely good set of relationship in terms of, most of the customers are repeat business, about 10 years, and customers are asking for different set of product offerings. So traditionally, we have got a lot of experience of providing the services to the customers. But now we have gone to a stage where, customers themselves are asking that why don't you provide, more enriched, if I may say, services which are more end-to-end, and that's what we are calling a solution. So I would say it's all driven based on A, our experience, B, the kind of customers we have and what is their need, and third, I think the opportunity where we feel that the opportunity in this solution is extremely high in terms of adding to the shareholder value.
Mr. Agarwal, I would presume a lot of your peers, large, mid, small, both local and global, would already be having some part of this strategy in their businesses already. Would this therefore mean that you will have to entail some pricing cuts, some margin sacrifices in order to get your foot in the door, if I can use that term, and expand the business meaningfully over the course of the next 5 years?
I think there are two parts to your question, if I can break it into two parts. I think one is in terms of the competition. We believe that we are in a very niche position in terms of our strategy. So most of the other players, whether in mid cap or large caps, where they are in engineering services or related businesses, they are not getting into end-to-end solutions. So we feel this is a differentiated play for us. And this will really give us, a much better standing from the market perspective. As far as margin is concerned, I think we have already been making investments, and in terms of preparing the organization for the new scale, new strategy. So there have been a lot of investments, and they're already baked into what margins you're looking at in the last couple of years, and those investments will continue as we move forward. But I think long run, I think the idea is that, at some stage we were, 18% margin company. Over a period of time, we have come down to 14%. And last couple of years, I think we have been sustaining at those levels. Idea is, I think we should move in the next 5 years, since you asked me a question, back towards 18% by having this more value-added portfolio of solutions into our portfolio. 5 to 10 years is the journey, as you rightly said right in the beginning, that 10 years is what we are looking at to execute this strategy. Yeah.
Interesting. Okay, so let me probe you a little bit on that. Let's think of a Cyient 5 years out. Would that Cyient have materially higher revenues because of the added business of solutions? I'm presuming that when you are looking to make solutions as the larger portion of your overall pie, that doesn't mean that you will dramatically cut down on the services business. It's just that more focus on solutions, so services continue as is, and solutions only becomes larger in size. Is that assumption correct?
Absolutely. I think your assumption is 100% correct. Let me explain to you that, when you're looking at our customers, because we are dealing with extremely good set of Fortune 500 companies in terms of most of our customers. Their spend is in the services side, which you typically call either as design or some services around some other domains. Then they spend a lot of money on build. Then they spend money on maintain. And what we have found is, if you look at the wallet size of our customers, if you only restrict to design side, it's only about 10 to 20%. Whereas if you really progress to the solutions and end-to-end, of course it will have to be for select industries and select customers. You really address a much larger market. So yes, your conclusion is correct. I think this is not to say that we will do less on services. but I think overall the growth will increase. So let me just conclude by saying that if you look at our company, historically our growth, depending on which periods of time you are looking at, has been about 12 to 15% in services. Our belief is that, if you have to get accelerated growth for the next 5 years, which is much, much higher than this growth rate from services, then solution is one of the elements of the strategy.
Interesting. And by just trying to understand the last two answers that you've given me, I would presume that the operational metrics improving dramatically over 5 years is a factor of the overall margins in the solutions business being substantially higher, because you would have to earn substantially higher margins to also account for the additional costs that you would incur, be it headcount or be it investments into the solutions business, and yet improve your margin profile by almost 400 to 500 basis points over the next 5 years.
No, you're absolutely right, Raj. As I said earlier, I think there are two parts. I think if you look at the growth of absolute profit, and if you look at the growth of, the operating profit, I think the addressable market, when it expands, then the growth of the top line is at an accelerated rate. So that's one part, that your overall earnings growth can be higher. Now, margin really depends in terms of percentage, which segments you are going into, which segments you are coming down. But in general, as I said, those investments are already factored into, what we have done in the last couple of years and now. So that pressure will continue on the margin. So we are not saying that in the near term, for the next 2 years or 3 years, we will drastically have an improvement in the margins. But 5 years from now, I think definitely we do see a significant upside into the margin as well. But I think it will be a combination of both. Your ability to grow on the top line becomes much higher because you are taking the larger pie of the wallet size of your customers. In the process, you're also likely to make more money when you take end-to-end responsibility. This part, as you rightly pointed out, this is small part of our business. This hypothesis we have to really test as you move along. So I think this is the direction we are pursuing. To be honest, I think as we keep proceeding, we will keep on giving you what is the progress and in which direction we are really getting to.
Sure. I mean, there are a lot of moving parts out here. Very difficult to pencil all of them in. I was just trying to get a sense of what's the vision with which you guys have embarked upon this. One question on whether this end-to-end solution providing with your set of clients that you have, does it increase the client concentration that you would have? I mean, it's true for almost all IT companies. The picture might be similar for a lot of them, that the top 5 clients constitute X% of revenues, top 10 constitute Y% of revenues. Because you are now catering to the same clients but a larger wallet share of the same client, and all of which are, as you said, some of which are Fortune 500 companies, would your client concentration go up from the current, I believe, 40% from the top 5 clients?
I would say yes and no, because I think when you go to the solutions, in the initial stages, when you are evolving, I think our comfort is much higher to work with the existing customers. So is the customer's comfort with us to be able to give us those end-to-end solutions. So I think initially, while we are working with the existing customers, the whole solution by nature of it, many of it we have also said is going to be IP based, and this would be then fungible across many customers. So I don't see that in a big way our concentration will change. But having said that, this concentration of customers works both ways. The way it has worked with us is that our growth is really fueled by top 20-30 customers, and we have a nice basket of different industries into 7 industries, and then you have various cycles between the industries and the verticals that we verticals and horizontals that we work on. And I think within that, I think we have seen between these 20 to 30 accounts, it has been more of a blessing than, or more of a strength than a weakness. That's our view on customer concentration.
Interesting. Would you believe that there could be a ramp up in large clients and large deal wins starting FY19 itself, Mr. Agarwal?
So I would say that, some of the deals which we are pursuing in terms of, end-to-end orders or, where a design and build is there, I think we are talking to many customers and we have in pipeline some good contracts. So there could be some large wins, but otherwise if you see our nature of business, I think typically it is 3 to 5% which comes from new wins, and practically 90-95% or 95 to 97% is a repeat business.
Okay, and now the repeat business might entail more share of the wallet from the client as well, which is very interesting. One small question, Mr. Agarwal, on the currency and the impact as well. Now, various estimates for various companies, but you're probably the best analyst for your company. Let me ask you, with the rupee doing what it is doing, is there a near-term tailwind that comes in for Science numbers?
Absolutely. I think definitely, like any other IT company, or actually we are an engineering services company, somehow we are called as IT company, we definitely get a tailwind at current exchange rates.
Okay, so will it be material? I don't want to get into a number really with you. We'll talk about the numbers when you come out with the quarterly numbers. But will it be material in quarter one itself? We've seen the range between 68, 68.5, or for a few brief days about 67. Most people who've estimated your earnings growth have worked with a number of 65, 65.5. Are we looking at a material tailwind in quarter one itself?
So I would say there are two plays on this. You gain on the operating profit side, and then you lose on the other income because your hedge positions, of course, tend to be a headwind for you. So I would say near term, as far as this quarter is concerned, I don't see a major benefit of this. But if this continues for the year, it's going to be a very significant impact on positive side or as a tailwind.
Interesting. Well, lovely chatting with you, Mr. Agarwal, on the strategy, and wish you all the best for executing this year after year. We'll, of course, be in conversation through all those quarters to try and figure out what stage you are at.
Thank you so much. Lovely talking to you. Yeah. All the best to you.
Thank you so much. Thanks for joining in today. Let's sign an interesting conversation, really, with a company which is embarking upon a completely different strategy than what they've done in the past. They have about 5% share in the solutions in their pie, which they hope to expand, or they aim to expand up to maybe 80-85% over the course of the next 10 years. Better margins, larger deal wins, should augur well if executed well. But the management will tell us quarter after quarter if they've done that or no. The stock flattish in the session today. The last 1 month has been a bit iffy as well compared to some of the other IT companies, but these things tend to move around very, very quickly. What are the markets doing before we call it a day on this leg of Indian Open? Well, a flat day for the markets as well. Nifty, Sensex, Nifty Bank, mid caps, small caps, almost all of the key indices are lying absolutely flat in the session today. Not seeing too many movers either at the broader end of the spectrum too. So the first 45 minutes of trade have been anything but exhilarating. Maybe the day has more in store. We call it a day on this leg of Indian Open. Mind you, a lot of stocks moving around in their derivative space. So the FNO show will take forward all of that action on the other side. Thanks so much for watching Indian Open.